Have you ever looked at traditional financial systems and, well, wondered if there are entirely different ways to operate?
Different approaches. Absolutely.
Ways not centered on debt, perhaps, but maybe on shared ownership.
Yeah,
Real assets.
exactly.
Today, we're embarking on a deep dive into something called Sukuk. These are fascinating financial certificates, really sitting right at the heart of Islamic finance.
They are. It's truly a crucial aspect, and it highlights how Islamic finance seeks to integrate directly with the real economy,
Right, not just abstract instruments.
not just dealing in paper, essentially.
So our mission for this deep dive is to really understand Sukuk. We're drawing directly from the DFM standard for issuing, acquiring, and trading Sukuk.
A key document.
Think of this as your shortcut, maybe, to grasping these unique financial certificates, their structure, their purpose, and importantly, how they operate under Sharia principles.
Yes.
We're going to explore what makes them tick and why they stand distinctly apart from, conventional financial products like bonds.
It's a very important distinction.
Okay, so let's start right there. Let's unpack this. What exactly is a SOC that's the singular form?
Right. That's right. SAC is singular, Sukuk is plural.
The term Islamic bonds often gets tossed around, but our source material is pretty clear. That isn't the most accurate description. Why is that distinction so important?
Well, it's a great question because it really gets to the core difference. Islamic finance fundamentally aims to collect funds and invest them through Sharia-compliant contracts.
Okay.
It's explicitly moving away from dealing in cash for cash or, pure interest-based lending.
Right, riba.
Exactly. So Sukuk are actually certificates that represent common shares in the ownership of tangible assets or the rights to use assets, what we call usufructs or other financial rights.
Ownership shares.
Yes. This isn't just some legal footnote. It fundamentally shifts the investor's role. You're not just a creditor, you become a partner in a way.
So if I'm understanding this correctly, it's not about lending money and earning a fixed interest payment, which, as you said, is prohibited, but about actual ownership and partnership in real-world economic activity.
Precisely. That's the heart of it.
That sounds like a very different mindset for an investor compared to just buying a bond.
It is. Unlike a conventional bond, which is basically a guaranteed interest-bearing debt owed by an issuer to its bearer.
A promise to repay with interest.
Yes. A SAC conveys real ownership or rights in tangible assets or their benefits. The source itself explicitly states that calling Sukuk Islamic bonds isn't really accurate in economic terms, even if they sometimes achieve similar financial goals.
It forces a different kind of due diligence then, maybe, and risk assessment.
Definitely. You're looking at the underlying asset or project much more closely.
Okay, that immediately raises a follow-up. How does Sukuk compare to shares? Because shares also represent ownership. There must be a difference, right?
There is, yes. Shares typically represent common rights in the assets of a specific legal company, right? And they stay in use as long as that company exists.
Standard equity.
Right. Sukuk, while they also represent common rights and assets, aren't necessarily limited to one specific company's total assets. They can be tied to specific assets or projects.
Ah.
And crucially, they're often issued for a specified period, after which they are redeemed. So they offer a different kind of flexibility, often linked to specific projects rather than the whole ongoing enterprise.
It sounds like there's a lot of careful structuring involved then to make sure these Sukuk truly align with Sharia principles. What does that architecture look like? Who are the key players? What kind of oversight is involved?
It's quite meticulous, as you'd expect. Issuing Sukuk involves several critical elements. It starts with a comprehensive issuance prospectus.
The rule book, essentially.
Pretty much. This document defines the underlying Sharia financial contract. Is it a lease, a partnership, a manufacturing deal? It details all the rules, conditions, legal consequences.
And it must include a feasibility study, too, right?
Absolutely. A thorough feasibility study, and importantly, it needs to be endorsed by an independent financial advisor certified by the country's Securities Commission.
Independent review.
Yes, so transparency and independent review are baked in right from the start.
That makes a lot of sense. And the Sukuk originator, the entity actually seeking the finance, they have a huge responsibility for all this information, I imagine.
Oh, absolutely. The originator guarantees the accuracy and comprehensiveness of all the data and information in that prospectus.
Guarantees. So there's liability.
Yes. Any intentional concealment or misrepresentation triggers their direct liability. It's a powerful incentive for accuracy, as you can imagine.
Definitely.
Then another crucial element is the special purpose vehicle, or SPV.
Ah, yes, the SPV. We see those elsewhere, too.
We do, but here it has specific Sharia considerations. The SPV is set up specifically for the Sukuk issuance. Importantly, it might not be allowed to be owned or managed by the originator if that creates a conflict of interest under Sharia rules, like selling or leasing assets to oneself.
Interesting constraint.
And the SPV also has to prepare annual audited financial statements. Accountability again.
Okay, so once the funds are raised through this SPV structure, how are the actual projects managed? Do they just get folded into the originator's normal operations?
No, and this is another key point for oversight. The project financed by the Sukuk proceeds has to be managed as an independent financial unit.
Separate books.
Completely separate. Its financial position and outcome must be clearly tracked and known at the end of the investment period. Its accounts must be distinct and independent from any other projects the originator might have.
And the returns based on the feasibility study.
Yes, the project should yield returns based on that initial study. And its financial statements need to follow AAOIFI's standards. That's the Accounting and Auditing Organization for Islamic Financial Institutions.
Global standards for this.
Yes, ensuring consistency and Shari'a compliance in accounting. Plus, these accounts are controlled by qualified financial controllers appointed by the SPV, not the originator directly.
And there's also a dedicated Shari'a committee involved throughout this entire process, watching over things.
Yes, absolutely critical. The prospectus must state that a Sukuk Shari'a Committee supervises and audits the project from start to finish.
What do they check?
They ensure all its activities, how profits are distributed, how losses are shared. Everything complies with Sharia rules. They provide regular reports to the Sukuk holders.
So the investors are kept informed by this committee.
They are, and significantly, this committee has the right to intervene if there's a flagrant infringement of the rules. It's a continuous layer of ethical and religious oversight built right in.
Wow, okay. So this sounds like Sukuk isn't just one thing. It's more like a whole family of financial products tailored for different situations.
Exactly. It's a diverse landscape.
Can you maybe walk us through some of the most common types? How do they actually work in practice?
Certainly. While there are many structures, maybe we can look at a couple of the most common ones to illustrate the idea, like Ijara and Mudaraba Sukuk. They represent different core Islamic contracts.
Okay, Ijara first. What's that based on?
Ijara Sukuk are based on leasing. So imagine a company needs, say, a new factory.
Okay.
Instead of borrowing money in the conventional sense, they could issue Ijara Sukuk. These sukuk would represent your common share in the ownership of the right to use that factory. It's usufruct, remember.
The right to use it, not the factory itself necessarily.
Often, yes. It's about the benefit, the use. The return you get as a sukuk holder comes from the agreed rental payments generated by leasing that usufruct back to the company that needs the factory.
So my return is linked to the rent?
Directly linked to the rent from that specific asset or its use. And it's important to note, the seller of the usufruct generally cannot guarantee the face value or the return of these sukuk.
Why not?
Because that would be like guaranteeing profit, which shifts it away from risk sharing. The emphasis is on the direct link to the asset's actual performance.
Okay, so with Ijara Sukuk, my returns depend on the rental income from a specific asset or its use. The focus is really on the asset's ability to generate revenue.
Precisely. Less on the issuer's overall creditworthiness, more on the asset itself.
Got it. What about the other type you mentioned, Mudaraba?
Right. Mudaraba Sukuk. These are often called investment sukuk. This structure is based on a Mudaraba contract, which is essentially a profit-sharing partnership.
By partnership?
Yes. Here, the sukuk holders like you provide the capital. And a mudarab, that's the manager, often the originator or a related party, invests that capital in a specific project or business venture.
And the return.
You, as a sukuk holder, receive a predetermined share of the profit generated by that investment. Not a fixed interest, but a share of the actual profit. And you also own a common share in the mudaraba assets themselves, which could be tangible things, usufructs, cash, financial rights, whatever the investment holds.
Okay, profit sharing. But what about the risk side with Mudaraba Sukuk? How is that handled if the project doesn't make a profit or loses money?
Crucially, the sukuk holders share the investment risks in proportion to their holdings.
So if there's a loss?
You bear your share of that loss. This is absolutely fundamental to Islamic finance. Risk and reward must be shared. No pain, no gain, effectively.
That's a stark difference from a bond's guaranteed principle.
A world of difference. And beyond these two, there are others too. You have Mudaraba Sukuk, which involve cost plus financing, usually for commodities.
How does that work?
Your sukuk might represent a share in the commodity before it's sold on, or a share in the debt owed by the buyer after the sale. Then there's istisna sukuk, used to finance manufacturing or construction projects. Your SAC is a share in the manufacturing process or the raw materials, then later a share in the selling price.
Always tied to something specific.
Exactly. And then there are contemporary applications, like Green Sukuk or Climate Sukuk.
Applying it to sustainability.
Yes, where the proceeds specifically finance environmentally friendly projects, renewable energy, sustainable infrastructure, low-carbon bioindustry, things like that. All these types reinforce that core connection to real economic activity, just using different Shari'a-compliant contracts.
It's a really flexible framework then, adaptable to different needs. Okay, so stepping back, what does all this mean for you, the sukuk holder? How are your rights protected in this system? And what are the rules around risk and returns, especially without conventional interest?
Well, as a sukuk holder, you do have important protections. For instance, holders of a particular issuance have the right to form an association, kind of like a union, with a legal representative.
To act collectively.
Exactly, to protect their common interests. That includes the right to pursue litigation against the originator or the SPV if things go wrong. It gives you a collective voice and a means of redress.
That sounds robust.
In terms of returns, as we discussed, you're entitled to your share in the investment return or the rent, whatever the structure is, as it's laid out in the prospectus. For investment sukuk, like Mudaraba, managers can sometimes guarantee the value of the sukuk assets, but only in specific cases.
Which cases?
Only if there's a breach, negligence, or actual misconduct on their part. And even then, the guarantee typically covers only the capital amount invested, not a promised profit.
So it's about accountability for their actions, not guaranteeing a return regardless.
Precisely. Accountability, not insulation from market risk.
That makes sense, responsibility for negligence. But I'm curious, you mentioned they can't guarantee profit. Can a sukuk manager ever guarantee a specific profit figure? Because that starts to sound a lot like interest again.
That's a critical distinction, and the answer is a clear no. It really highlights the core principles here.
Okay.
An investment sukuk manager, whether they're a mudarab, a partner, an investment agent, is not permitted to guarantee a determined profit for sukuk holders. Full stop.
And they can't just lend the difference if returns are low?
No, they also can't undertake to lend money to sukuk holders if there's a shortfall in expected returns, because that would combine a communicative contract with a loan, which is prohibited. It could sneak in that element of guaranteed return, like interest, undermining the risk-sharing principle.
So what can they do if there's a genuine shortfall?
Well, if there's a shortfall, the manager can try to source other Shari'a-compliant financing, or maybe even an interest-free loan, a qard hasan, to cover it temporarily. But crucially, they would then claim that amount back from future profits or from the sale of the assets when the sukuk matures. It's a temporary bridge, not a guarantee.
Got it. And the issuer's responsibility at maturity.
The issuer commits to liquidating the sukuk assets and refunding the capital, plus any realized profit when the sukuk matures, if they claim the assets were damaged, lost, or impaired.
Reducing the payout.
Right. If they make that claim, the burden of proof is entirely on them to show it wasn't because of their own breach, negligence, or misconduct.
Innocent until proven negligent, almost.
In a way, yes. The default assumption is they managed properly unless they can prove otherwise.
So managers clearly have incentives for good performance, but they aren't totally off the hook for poor decisions or mismanagement. It seems like a careful balance.
Exactly. And to encourage good performance, the prospectus might even stipulate that the manager gets a bonus, maybe all, or part of the profit that exceeds a certain target level.
An incentive fee.
Yes, on top of their regular fees or profit share. This incentive is usually calculated over the whole sukuk term and paid at maturity, though sometimes advance payments might be allowed. It balances rewarding success with maintaining accountability.
Okay, knowing all this complex structure and the rights involved, what happens if you, as a holder, want to get out before maturity? Can you sell your sukuk? Can you trade them freely, like a conventional bond on a secondary market?
Generally, yes. The owner of a SAC can usually sell it, either in a secondary market or privately, to any buyer, except, interestingly, not back to the issuer itself, typically.
Why not to the issuer?
That could be seen as circumventing rules, potentially creating a loan-like structure if the issuer guarantees a buyback price. So usually it's sold to a third party. And the price is determined by market demand and supply. just like other securities.
But are there restrictions?
Yeah.
You mentioned different types.
Yes, there are specific rules depending on the type of sukuk, always reinforcing that link back to the underlying real assets or services.
Can you give an example?
Sure. For sukuk based on leasing assets that haven't been delivered yet, like masufa bathima, where the asset is described but not yet owned or ready,
Okay.
those sukuk are generally not tradable until the underlying assets have actually been delivered and the lease effectively starts.
Because there's no real asset generating value yet.
Precisely. Or think about sukuk representing services. They might be tradable before the service is fully delivered or used up because they represent title to those future services. But after the service is fully used, no, they become non-tradable then as the underlying value is gone.
What if only part of the service is used?
That gets tricky. The ratio of utilized to unutilized services has to be considered very carefully to determine tradability to avoid fictitious transactions where it looks like you're just trading debt.
So the tradability is always intimately tied back to the status of the real asset or the real service it represents.
Exactly. That connection is fundamental and maintained throughout the sukuk's life, even in the secondary market.
It makes a lot of sense, given everything we've discussed about the emphasis on real economic activity.
Precisely. Even for, say, investment portfolio sukuk, where the sukuk represents a share in a mixed portfolio.
Assets, cash, debts, maybe?
Right. Even there, strict rules apply. For instance, the proportion of cash and receivables, debts, in the portfolio usually can't exceed a certain limit, maybe 90% according to this standard, sometimes less depending on interpretation.
Why that limit?
To ensure the transaction doesn't become, in essence, just trading cash for cash or trading debt, which has its own strict rules in Sharia. It keeps the link to tangible assets dominant. It prevents the portfolio from becoming a purely financial, non-asset-backed instrument in disguise.
What an incredible deep dive into the world of sukuk. Seriously, we've journeyed from their foundational principles in Islamic finance, looked at all these diverse structures, the really strict oversight mechanisms, and then these intricate rules governing trading and investor protection.
It's a complex area, for sure.
It really reshapes your understanding of what an investment can be, moving beyond just debt.
It truly highlights how Islamic finance, through instruments like sukuk, really tries to distinguish itself. The emphasis is squarely on asset-backed transactions, on genuine risk sharing.
Moving away from purely debt-based models.
Exactly. It's a financial ecosystem built on, well, different foundations.
Okay, let's try and unpack the core idea here. The way sukuk link financial instruments directly to tangible assets, to real economic projects, it provides such a fascinating alternative perspective to conventional finance, doesn't it?
It really does.
It makes you reconsider the very essence of investment, what it means to truly own a piece of economic activity, rather than just holding someone's promise to pay.
And that's the powerful idea, I think. Knowledge is most valuable when it's understood and maybe even applied right. So what stands out to you, the listener, having heard all this? How do sukuk operate within these parameters in a way that strikes you?
Yeah, something for you to mull over, perhaps. Considering the strong emphasis on real assets, on shared risk, and that robust, multi-layered oversight, how might the principles embedded deep within sukuk offer new perspectives, or maybe potential solutions for some of the challenges we see in the broader global financial system? Thinking about stability, or perhaps sustainable development challenges. Could there be lessons there for the conventional economy?